Main Street stock, ticker symbol MAIN. This stock is up almost 14% year to date, and it has tanked a lot lately. On the 9th of May, Main Street presented their quarterly earnings where they beat on revenue and EPS. People love Main Street stock because of multiple reasons, one of them being the dividend, and I understand why with dividend yield at 5.8% and of course with the monthly payouts. Looking at the 5-year returns including dividends, we see that Main Street underperformed the S&P 500, but most recently they are closing the gap. So could this be the perfect moment to buy Main Street stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Main Street do? Main Street Capital Corporation is an investment firm engaged in providing customized debt and equity financing to lower middle market companies and debt capital to middle market companies. The investment portfolio of the company is typically made to support management buyouts, recapitalizations, growth financings, refinancings, and acquisitions of companies that operate in diverse industry sectors. Diving into the earnings, we see that total net investment income was reported at $131,000, up 9% year over year, looking pretty good to me. Distributable net investment income, or DNII, increased 10%, and the DNII margin increased 66 bps, which is pretty impressive. All these numbers are year over year, compared to the fourth quarter of 2023. We see that DNII margin is decreasing a bit. It is the same with the DNI per share, but still these earnings look pretty good to me. Looking at the net asset value, or NAV, we see that it is increasing year over year, but also quarter over quarter. To me, this is looking pretty good. Looking at the net debt to NAV ratio, I also get really excited with 0.8 to 1, which is a great range. And here we see that Main Street never cut the dividends. In fact, they added a lot of supplemental dividends, which is very nice. During lockdown periods, they didn't increase the dividends, but more on that in a minute. For me, it is very important that companies like Main Street are very diversified. And here we see that the biggest industry is at only 7%, way lower than my 10% maximum. So this looks really good to me. And here we see the transaction type breakdown and geo breakdown. Both are looking really good to me as well. Looking at the investment volumes one more time, we see that growth is slowing down a bit to 10%, which is still a great number in my opinion. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. Main Street is a 4.2 billion market cap company. PE ratio is at 9.2, indicating they are undervalued. Later in this video I will show you my 3 price targets for Main Street stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 541 million, and in this graph we see that revenue went up in the long run. And of course we see the impact during COVID, and most recently revenue is really increasing at a high pace. Margins are going up and down in the past decade. During the lockdown periods, margins crashed. After that, they recovered pretty quickly, and most recently it is also increasing again. EPS is pretty much the same story as the revenue and margins. Nothing special to add here. Analysis expect that EPS will decrease from here in the coming 2 years, which feels a bit random to me. I don't see a clear reason why this would happen, to be honest. For the revenue analysis expect pretty much the same. Again, I don't see any signs of this actually happening. Especially the 25% decrease feels random to me. Return on assets is sitting at 10%, which is a great number. Return on equity is at 18.4, which is also a great number. This is also one of the most important numbers for Main Street. Current ratio is at 0.98, which is a decent number. Right now, Main Street has 1.8 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Main Street has 60 million in total cash, so they can't pay down a big part of their debt. To me, this could be a potential red flag. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is at a negative number most of the time. And to be honest, I don't like this at all. Most recently it is finally reported at a positive number. Shares outstanding are increasing in the long run, which is something that I don't like in general. But companies like Main Street issue new shares to raise capital, so I don't mind that much. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 5.8%, which is a great number. Keep in mind that Main Street pays a monthly dividend instead of a quarterly dividend. Annual payout is at $2.88 and payout ratio is at 50%. I prefer 50% or lower, so right now they have 50% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 3.9%, which is a decent number. They have increased the dividend for 3 years in a row, which is very nice. If you take a look at these numbers, the dividends paid since 2012, you see that Main Street did increase the dividends at a decent rate. However, during the lockdown periods they cut the supplemental dividend, which was a smart move but ended the growth streak. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio used to be a bit high, but it is coming down a lot, which is a good thing. In this graph we see the expected dividends in 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to increase at the same rate as the past couple of years. And overall these dividends look really good to me, but how about the historical returns? I decided to compare Main Street stock with the overall market, in this case the S&P 500. Next to that I added ARCC and Blue Owl Capital. On the 5-year chart we see that Main Street was beaten by the S&P 500 by quite a difference. In total Main Street returned 79%. And keep in mind this is including dividends. The S&P 500 is sitting at 97%. ARCC was pretty close beating the S&P 500 and OBDC had the lowest return here. On the 1-year chart things look pretty interesting. Main Street returned almost 35%, while the S&P 500 is at 28%. So Main Street managed to beat the S&P 500. It's the same with OBDC that had a massive 48% return. On the 6-month chart, Main Street was again really close beating the S&P 500, but had a slightly lower return. Again, OBDC had the highest return here. On the 1-month chart, it is again Main Street that beats the S&P 500, and again OBDC had the highest return. So bottom line, Main Street is really getting some momentum lately, but on the 5-year chart, the S&P 500 was still the winner. So could this be the perfect time to buy Main Street stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 82, 84 and 86%. For the free cash flow margin, I'm putting in 26, 28 and 30%. For the PE ratio, I'm putting in 10. For the price of free cash flow, I'm putting in 13, 14 and 15. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety with this company. Right now, Main Street stock is at almost $50. I hit analyze, and we see a lot of green numbers. I'm more focusing on the multiple earnings value. We have a low price target of $55. We have a mid price target of $64 and we have a high price target of $75. To me, the low price target is the most justified here. So that means they are undervalued based on this number. What do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Main Street is that I love the business. To me, it is a high risk, high reward investment in a way. I really love the monthly dividends they pay and most fundamentals look good to me as well. Of course, there are some concerns with the free cash flow margin, debt and future outlook by the analysts. Other than that, most things look pretty good. From a dividend point of view, I really get excited with a high yield and relatively low payout ratio. From a value point of view, I also get excited with numbers that show Main Street could be undervalued. Since this is a higher risk company, in my opinion, I'm trying to limit my exposure. Meaning I'm waiting for a small pullback before I add more shares. Also to have a bigger margin of safety. In the meantime, I keep collecting the dividends and from time to time analyzing them. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.